Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, March 1st, and then we'll see how things look for Thursday, March 2nd. We had another down day. Our technicals are still suggesting that we're seeing weakness in the market right now. However, we did get right down to the 200-day simple moving average, and right now that's acting as pretty good support. The question is, can we bounce up off of that, or are we just waiting until we drop below it? In the meantime, we're kind of chopping sideways, more or less. So let's go back and talk about what happened. Right at the open, we had a lower open, and prices were really choppy right after the open. We ended up making our way down below S1 at 39.60. We fell also down below S2 at 39.50, and then we hit support at the 200-day moving average, which is at about 39.40. As the day went on, prices then rebounded and got back above S2, S1, and then we hit resistance at the unchanged level, which is kind of a built-in support or resistance level that we have to deal with many days. Prices then declined back down to almost the intraday low before closing slightly above S2. We were down 0.47% on below average volume. We had seen a real pickup in volume. Well, in Wednesday's session, it dropped down below average again. The technicals are still negative overall because we're having this real battle going back and forth about inflation and interest rates and what is the Fed going to do or not do. That's feeding over into the earnings per share as well as valuation concerns. We have the whole list of geopolitical concerns with Russia-Ukraine more at the top. And then we're getting near the end of earnings season, but we're still seeing reports coming out. Here's the intraday chart showing how we had a lower open. And we just chopped around like crazy. We were trying to go back up. We came down below S1. We actually dropped down below S2 before bouncing back up. Eventually, we came right down to this level, and I went ahead and put the 200-day simple moving average on here. S3 was down well below this, so we didn't hit that. But we hit this 200-day simple moving average, bounced up, came back up to the unchanged level, chopped sideways, and then fell back down. We didn't quite get down to the low set earlier in the day, before seeing a little bit of a bounce going into the close, and then weakness on the very last bar, which allowed us to close just a little bit above S2. What are some comments that we can make? The indexes closed mixed. We had things like the small caps and the mid caps were up. The Dow was up slightly, but then the S&P and the Nasdaq were down. The S&P is still above its 200-day simple moving average, so that's positive for right now. But we're getting dangerously close, and some bad news or some wave of selling comes into the market, and that could take us below that level pretty easily. There was some Fed speak that we had to deal with. Minneapolis Fed President Kashkari, who's a voter right now, said that he's leaning towards raising rates further. Atlanta Fed President Bostic, who will be a voter next year, said that he thinks the Fed should get to the 5 to 5.25% level and hold it there well into 2024. The markets really didn't like that. On a short-term basis, we still have our stochastic, Stoch RSI, and the Williams percent are extreme negative. On an intermediate-term basis, this list hasn't changed that much. The McClellan Oscillator, the PMO study, and then the CCI 14 was added back to this list, and a continuation of the CCI 20 being on the list. The dollar was down and interest rates were up. So the dollar being down should have given some support to stocks, but the fact that interest rates are going up, that provided headwinds. We still have all of our yield curves that remain inverted. Sentiment is still positive. We're drifting a little bit lower now. We're at 56 where we had been at 58. Our trend is now switched back over to negative. Even though we're not trending, we're below 20 as far as the ADX. But the red line has now gone on top, and I'll show you the chart of that. So we have a weakening trend. Our bias is now negative, and our momentum is negative. The economic reports that came out, we had the weekly MBA mortgage applications index. It came in down 0.57%. Last week, it was down 13.3%. The IHS market manufacturing PMI, the final reading, came in at 47.3, a little bit lower than the 47.8 they had expected. This is below 50, so it is showing contraction in the economy. The ISM Manufacturing Index, this was the biggie. It came in at 47.7. They expected it to come in at 47.8, so a little bit weaker than expected, and up from the 47.4 that we saw last time. One thing that was a real concern is the prices index. It rose to 51.3% from 44.5%. So we're seeing some inflationary pressures in this report that the market really didn't care for. Construction spending was down 0.1%. They expected it to be up 0.3%. Last time it was down 0.7%. Then looking at our charts, the Ulcer Index continues to inch a little bit higher, showing, according to this indicator, that fear is coming back into the market. But we're just not seeing that as far as the VIX. We had a down day, but it declined on a closing basis on the line chart. And it's also going pretty much sideways on the bar chart and dropping below the moving average. So this is just suggesting that there's a lot of complacency in the market. And this is also reflected in the VIX of the VIX, where volatility is really dropping off on the bar chart, and it's slightly lower on the line chart. The ADX helps to show us the condition of our trend, where the ADX is the black line, and it's declining and below 20, so that's a weakening trend, plus we're below the moving average. The red line came back up on top, so selling pressure takes the default as far as being negative, where buying power has been decreasing. Looking at the daily chart, we're coming right down to this red line, which is the 200-day simple moving average. So far, this is holding as support. And looking at this trend line that we finally broke through earlier in the year, we're coming back down to it. We're still staying above it. If we break through the 200-day moving average, we might end up breaking through this trend line as well. This upward sloping trend line, we've already broken through that. Down on the bottom, see where volume really dropped off to well below average. Looking at our stochastic study, in the short term, we're extreme negative. Intermediate term, extreme negative. We're still declining in the longer term, short term version of this chart. The Stoch RSI and the Williams percent R remain extreme negative. We're seeing a real pickup in selling with our Rune indicator. So the red line's going all the way to the top and the green line is declining. And we're seeing our oscillator, which had already dropped below zero, it's continuing to decline and not necessarily extreme negative yet. Our 50-period moving average shows how we've dropped below that, both with the simple and exponential moving average. We're also dropping below the 100-day exponential moving average. The green line is the simple moving average, which may provide some support if we continue to fall. Our moving average tree, again, just showing how we're coming back down into the tree itself, and it's making our shorter term moving averages start to roll over. Chaikin oscillator is still negative. It dropped below zero and is declining. The CCI 14 just barely extreme negative, and the CCI 20 continues to be extreme negative. The PMO study, we're still extreme negative with the percent of PMOs that are rising. We're also extreme negative with the percent of buy signals, and we continue to decline with the PMOs that are above zero. This chart is potentially positive. The Swenlin trading oscillator based on price and volume continue to go up. Sometimes this leads the market higher. If we're going to find some support at the 200-day moving average and bounce up, that's what this indicator might suggest. But we don't always know if this indicator is helpful or not until after the fact, but we still want to be aware of this. The BPI is dropping a little bit further below 50, so that's more negative and declining. The broad measure of the NYSE BPI shows how we're continuing to decline. The Chaikin money flow also continues to decline. It's positive with the green bars, but they're going down, 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 and we could switch over to negative fairly soon. The balance of power, even though it ticked up slightly, we're still below this dashed line, so that is negative. The TTM squeeze continues to go down as far as the red bars are being drawn. And the go-no-go system is now turned to a lighter shade of purple, which is negative. Our short-term fib level's not really hitting anything right now. If we go back up, we have resistance at the 4,007 level. If we continue to fall, we're looking at the 3908 level. Longer-term fib chart also not really showing anything decisive right now. And then the very long fib chart showing how we're continuing to be in no man's land. If we do start to go back up, we're looking at the 4,020 level as being overhead resistance. S&P 500 Elder Impulse System remains neutral. And our McClellan oscillator is still extreme negative when it's measuring the S&P 500. But when we look at it measuring the NYSE, it's negative and turning down slightly, but it's not extreme negative. The summation index based on price and volume continued to decline, with volume dropping below zero. And I brought up our Ichimoku cloud just because we're getting kind of close now to a potential support level. If we continue to go sideways, we'll bump into this green cloud, which may end up providing support. New highs, new lows, not really seeing a lot of expansion either way, so our 5 period continues to decline, and our 10 period is also declining. The advanced decline line, based on price, is still positive. We're above this red moving average, but we are declining. Also based on volume, above the moving average, but coming down. The advanced decline ratio continues to be below zero and is declining. The accumulation distribution, we dropped below the moving average yesterday, while we continue to be below that moving average after today's session. And volume, which had turned back up in Tuesday's session, dropped back down in Wednesday's session. The diamonds, after being negative, have been able to switch back to neutral, but we're not seeing a real positive action as far as the price bar is concerned. The NASDAQ 100 is also dealing with its 200-day simple moving average. So far, that support level has been holding. We'll be watching both of these indexes to see what happens. By both, I mean the NASDAQ 100 and the S&P 500. The Qs have switched over to negative. The small caps are neutral when looking at the Elder Impulse system. The ratio between small caps and the S&P 500 does show that small caps are holding up and they're outperforming the S&P. We're in an overall uptrend, and this is breaking out a little bit, so that could give some support to the S&P 500. The mid caps continue to be neutral. And looking at bond yields, the 10-year yield is getting right back up to 4%. We broke above it intraday, but then closed just below the 4% level. And then this is an inverse of that same chart where yields are going up. That means bond prices are going down. If you look up on top, we have a declining RSI below 50. And on the bottom, we have a MACD that is also declining. Just an update of our possible positive scenario charts. This is the small cap to S&P 500 ratio. I showed that chart a moment ago. This also plots the blue line, which is the S&P 500, where we're starting to break out a little bit against the S&P. So this could give some support. The S&P to utilities ratio also breaking out a little bit. We're not seeing it based on price yet, but this could give some support to the S&P. And the 2-year Treasury yield, we've pretty much have taken out this earlier spike that we had been working off of. Now we're watching the 2-year going up. When it tops out and starts to come down, we'll then look at that spike and evaluate things at that time. The Staples to S&P 500 ratio is starting to decline again. So we still have a valid spike here, but we're just not seeing follow through with price. What's our outlook for Thursday? The technicals are still negative, and we're still at least short-term oversold and slightly intermediate-term oversold. We have the revised fourth quarter productivity as well as the unit labor cost reports coming out. We have the weekly jobless claims, and then the whole list of geopolitical events that we're keeping an eye on. The markets are still really fixated on the inflation and interest rate scenario, but any one of these other things could come to the forefront. We do have a speech coming up on Thursday given by Governor Christopher Waller. That'll be at 4 p.m. Eastern time, right at the time the market closes, so it likely won't have any kind of impact. And then on Friday, we have another speech that will be coming up. Looking at our Stock Trader Almanac statistics, if you want more of an in-depth discussion for the month of March, please view the video for Wednesday. I'm just going to go down to the day where for March 2nd, we're looking pretty negative overall. The Dow and the S&P are only up 33 1/3% of the time, with the NASDAQ being up only 38.1% of the time. So we're getting into some early month negative seasonality that I'll show you here in the chart in just a minute. We do have a tendency to be positive in the month of March, but we're kind of hitting a rough spot in the month of March right now. And then we have our 3-0 trifecta, which is more of a longer-term positive backdrop. Here is the chart that I'm talking about. Number 2 here is the second trading day. It just so happens to line up with the second day of March, where we do see some weakness here. We might see a little bit of a bounce going into Friday's session, but then next week is when we see some pretty significant weakness before things start to bounce and then recuperate a little bit better as we go on in the month of March. We're also keeping an eye on this chart where the line that we're following is the green line, which is the pre-election after a midterm bear, because we're in a pre-election year right now and we had a bear market last year. So we're watching this green line to see, can the S&P perform similar to how this green line did historically. And then we're also getting ready to come into the sweet spot for the S&P 500. We'll bounce around a little bit and things might get negative, but if we can break through out of that and then start to go higher, we might be able to stick with what has happened historically. So our scenarios, it's kind of hard to go with the down one right now because we're not trending. Even though our technicals are negative, we're short-term oversold, and we've been that way for a few days now. Can't go with the up one because our technicals are negative, so we're continuing to go with our sideways trend because the ADX is weakening below 20, but we default to negative because the red line has now gone back on top. So our conclusion, the S&P is negative and short-term oversold. The same conclusion that I had yesterday. Short-term negative and mostly oversold. Intermediate term negative and slightly oversold. But we're still above that 200-day simple moving average, so we continue to be positive longer term, and we're still working off of a recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.